it's tempting to consider marketing and finance to be completely separate business disciplines. Marketing is often thought to be subjective, dealing with edgy stuff like brands and TV commercials. Finance, on the other hand, is generally thought of as a matter of hard, cold numbers. In reality, as most experienced business leaders know, the two disciplines are deeply intertwined in the successful management of a business venture. Marketing is one of the most essential drivers of business profitability and high valuations. Marketing and finance are two sides of the same issue, both answering the same fundamental questions that every business must answer. Who will buy the most of our product at the highest price, and how do we get as many customers as possible and keep them loyal for an extended period of time? Imagine that you worked for the CEO of Coca-Cola. He asks you for an opinion on a recommendation by the company's chief marketing officer to raise advertising budget from $3.2 billion to $3.5 billion. Should Coke spend an additional $300 million on advertising? The chief financial officer is opposed, saying the money could be spent better elsewhere, or alternatively, just keeping the ad budget flat could increase earnings and drive stock price up. The CMO counters that the increase in ad spending is actually an investment in the brand, and one that will result in higher sales and earnings as well. This was actually a decision facing Coca-Cola senior leadership in 2013. Already the biggest advertiser in the beverage industry, Coke was spending almost 7% of its revenue on advertising at the time. The question becomes, what should Coke do? What would you advise the CEO? Is marketing an expense or an investment in an intangible but extremely valuable asset known as the brand? Is it both an expense and an investment? How should the company treat marketing from a financial point of view? There's a fallacy that marketing and finance are separate disciplines. In truth, both disciplines are about the same thing: how a business sustainably earns, grows, and increases its value. Marketing is one of the main drivers of earnings, growth, and valuation. Finance is simply about measuring the effects of marketing, from the basic advertising and messaging to product design, to the scope of product lines, and ultimately to decisions about how to operate in certain markets. Applying these concepts to the Coca-Cola situation, considering the following conundrum. In the middle of 2018, Coca-Cola's balance sheet showed total assets of $89 billion. Yes, the company's market capitalization, the total value of the company, was $199 billion at the time. Why are the two numbers different? The $110 billion premium of entity value on the books signifies how important brand is to Coca-Cola. Is the Coca-Cola brand worth more than that of its competitors? Perhaps, if you look at the ratio between the stock price and the company's earnings, the P&E ratio, Coke trades at around 33 times earnings. In contrast, Pepsi's P&E is just 21. Thus, in rough terms, a dollar of earnings generated by Coke's marketing machine is worth $33 to shareholders versus $21 of Pepsi's earnings. But wait, aren't stock prices based on expectations of cash flow? Yes, they are, give or take various other influences. The value of a brand surfaces in the stock price because of its ability to generate and assure future cash flows. From this perspective, the intersection between marketing and finance becomes clear. Marketers must understand finance. Finance is the way the firm reports its performance, it's the language of the firm, and it's the way we can measure outcomes on a common scale. But finance doesn't generate profits. Finance measures profits. Marketing generates profits. Marketing generates growth. Successful businesses, therefore, must understand both finance and marketing and the relationship between them.